All right, let's talk about a word you hear literally everywhere in trading: liquidity. Everyone throws it around. But what if I told you that the common understanding of it is just completely wrong? And that misunderstanding, well, it could be the very thing that's costing you money. Today, we're going to tear it all down and build it back up the right way.
I mean, really think about it for a second. If the very foundation of how you see the market, this whole idea of liquidity, is shaky, then every single trade you build on top of it is on unstable ground. It's just not going to work long term. Getting this right isn't just a nice to have, it's absolutely critical. So before we even get to the real definition, let's start by clearing out all the junk.
That's right. To really get what liquidity is, we first have to be crystal clear about what it is not. And trust me, there are a lot of myths out there. Yeah, you've heard them all, right? Volume, volatility, buying pressure. A big candle shoots up and someone in a chat room says, "Whoa, look at that liquidity coming in." Or you see a ton of volume and you think, okay, that's where the liquidity is. We've all done it. But that right there is the core of the whole misunderstanding.
See, all those things we just listed, the volume, the volatility, the big moves, they're not the cause of anything. They are the result. They're the effect. It's like seeing smoke and calling it the fire. No, the smoke is just the sign that a fire is burning somewhere else.
So here's the correct way to think about it. Liquidity is the cause. It's the fuel in the tank that allows the car to move. The movement itself, the price action, the volume, the volatility you see on your screen, that is simply the effect. That's the car driving down the road. Okay, so now that we've cleared away all that noise, what's the actual definition? Well, it's way simpler than you probably think.
So forget all the complex guru-level theories. The real definition is this: liquidity is simply the available orders in the market waiting to be executed. That's it. It's not magic, it's not some mysterious force, it's just orders.
So, where do we find these pools of orders? Well, they tend to cluster in predictable places. Places where traders are forced to act. Think about it. Stop losses that have to get triggered. Liquidations that can't be avoided. Any pending orders sitting on the books. That's where liquidity lives.
And this creates a really crucial split in the market. On one side, you have willing participants. They choose when to buy or sell. But on the other side, you have the forced participants. These are the people whose stops are getting hit or who are getting liquidated. They have no choice in the matter. Their orders must be executed right then and there.
Now, why is it so important? Because these forced orders create certainty. And for the big players, the institutions trying to move massive amounts of money, certainty is everything. They need to know they can get their huge orders filled without causing the price to run away from them. So what do? They actively hunt for these zones of forced action.
Okay, so we have the right definition now. That's great. But what's the so what? I mean, how does this actually change the way you look at a chart and make trading decisions?
This right here, this is the fundamental shift in mindset. Most traders are obsessed with one question: is the price going up or down? But the pros, the smart money, they're asking a totally different question. They're asking, where are the pools of orders? Where can I get my size executed efficiently? They focus on liquidity first, and the direction comes second.
Think of it like this. A big move on the chart is the journey, right? But the car can't start the journey until it gets fuel. The market first has to go find that fuel, those pools of forced orders. Only after it's filled up the tank does the real directional move begin. Liquidity is what gives price a reason to go somewhere. And this also helps us make sense of volatility. It's not just random chaos. When you see a period of low volatility, like a tight range or consolidation, that's often liquidity being built. Stop losses are piling up above the highs and below the lows. Then, boom, that sudden explosion of high volatility, that's the sound of all that built-up liquidity being consumed.
Now, this whole concept is fractal. It happens on the 1-minute chart, the daily chart, the weekly chart, you name it. But here's the thing. Not all liquidity is created equal. The lower time frame stuff is useful for timing your entries, sure, but it's the higher time frame liquidity that really dictates the major turning points and the overall direction. The big picture always wins.
This also explains that super frustrating thing that happens all the time. When price pushes just past a key level, stops you out by a few ticks, and then reverses, it's not overshooting. It's just completing its task. The real prize, that big cluster of stop orders, was sitting just beyond that clean level. Once it grabs those orders, its job is done. It has zero reason to hang around there anymore.
And the same logic is behind those really sharp, clean reversals.
They don't happen because of some magical chart pattern or an indicator crossing over. They happen for a very mechanical reason. All the forced sellers, for example, have been washed out. A major pool of liquidity has been cleared, and now the market is free to rebalance and go hunt for orders in the other direction.
Okay, so let's put this all together. How do we start using this correct understanding and apply it like a pro, instead of getting caught in all the usual retail traps? Here it is, the single biggest mistake you can make, being reactive. You wait for a huge move to happen, and then you point at it and say, oh, that was a liquidity grab. You're analyzing the past. That's not going to help you trade what's coming next. Professionals do the exact opposite. They are proactive. They look at the current market structure and ask, okay, where is liquidity likely building up right now? They anticipate where the market will be drawn to before it gets there. And honestly, that one little shift from reactive to proactive is pretty much the whole game.
So if you take away one thing from this, let it be this. Liquidity is not an entry trigger. It is not a signal to just blindly buy or sell. It is a context tool. It's the framework that helps you understand the story the market is telling. It helps you figure out where price wants to go, know when a move is probably finished, and filter out a ton of bad trades you might have taken otherwise.
So let's just hammer this home. Liquidity is not a signal. It's not a setup. It's not a guarantee. It is the reason price can move. It is the fuel for all market behavior, and it is the absolute foundation of price action itself.
It really all boils down to this simple idea. If you misunderstand liquidity, you spend your career trading the effects. You're always reacting, always one step behind. But if you truly understand liquidity, you start trading the causes. You start anticipating, and that is the edge. And we'll leave you with this final thought, because it's so important. Understanding liquidity isn't about having a crystal ball that predicts the future with 100% accuracy. It's about being able to explain the present. It allows you to look at a chart and understand why it's doing what it's doing. And when you can do that, you can build a high probability case for what it might do next. It's not a prediction machine. It's a map of the market's intentions.